Hi everyone, we are going to start with our demonstration problems for chapter 10. So this is demo problem 10.1, identifying product costs. So we are looking at Eiffel Manufacturing Company, and they make small replicas of major landmarks that it sells to souvenir shops. The company was started on January 1st, year one. It acquired $60,000 cash from the issue of common stock. During year one, the company purchased and used raw materials that cost $16,000 cash. It paid wages of $22,000 cash to the workers who made the replicas. And they finally had manufacturing overhead costs, including rental fees paid for the facility and the equipment, that were $12,000 cash. The company started and completed the production of 1,000 replicas during year one. All right, so the first thing we need to look at is determining the amount of expense that they incurred in year one, assuming that none of the replicas were sold in year one. So this is where we've got to look at our product costs. Now, thinking back to the first video, the last video that you should have watched, that talked about what product costs were when we look at our direct material, our raw material, our direct labor, and our overhead costs. We see that we get raw materials of $16,000, wages of $22,000 to the workers who made the replicas, so that would be our direct labor, and then our manufacturing overhead costs of $12,000. So that means that our total expenses were $16,000, $22,000, and $12,000 cash. However, we didn't sell any of those replicas in year one. And those are all of our product costs that become our cost of goods sold. Since we have not sold any of the replicas, that means that the amount of our expenses in year one is zero. All of the costs that they talked about are product costs. So since nothing was sold, we have no cost of goods sold, and all of that, so if we add that up, let's do that. 16,000 plus 12,000 plus 22,000. Go ahead and do that. I'll give you a couple seconds. That should come out to 50,000. So all of those costs are in our finished goods inventory asset account. So next it says, determine the cost per unit of the 1,000 replicas. Well, we just need to look at our product cost and divide it by the per unit cost, or product cost per unit. So we know that our product cost is the raw materials plus the direct labor. So to our raw materials plus our direct labor plus our overhead. We know that all of that from up above is 50,000. And then we divide it by our number of units. So when you take 50,000 divided by 1,000, should end up with $50 per unit. All right, so that was part A and part B. Part C says determine the sales price per unit, assuming the products are sold for cost plus percent of cost. So what that means is we are going for a 40% profit. We want to increase the cost by 40%. So we know that they cost $50 per unit. So we have to take our 50 and figure out what 40% is. Should be 20. So if we're going to sell it for a 40% increase, we get our 50 plus 20 to find out that we should be selling them for $70 each. So our cost of goods sold per unit is $50 per unit, but we're actually selling them for 70, so we make a little profit. All right, so there's part C. Part D. Assume that Eiffel sold 800 of the replicas in year 1, and we paid a $4,000 sales commission. All right, so let's figure out that step. So if we sell 800, what is our cost of goods sold going to be? Before we get to the next part, let's just figure that out. So if we have 800 sold and our cost of goods sold is 50 per unit, should find that our COGS is 40,000. So now we sold them, we're going to put this into our expense column in our income statement. So we're saying, all right, we've got $40,000 worth of goods sold. How much did we actually make on that? Well, let's do 800 times 70. Because that's what we sell each one for. Should get 56,000. All right, so then we pay $4,000 in sales commission to that salesperson. Does the salesperson have anything to do with the product, with the creating of the product? I hope you said no. So that goes into that selling and administrative costs. So those are period costs. So this part right here is a period cost. So now part D says identify 7 events associated with making and selling the replicas. All right, so basically what we're doing here is we're just identifying the 7 events that we're going to put on our horizontal statements model. They already gave us the first one. And that's what most of our examples have started with throughout this year, is simply acquiring $60,000 for common stock. Oops. If I can spell acquire right. And they gave it to us in cash, so we have $60,000 cash from common stock. All right, so that was the first thing. Now let's come back up here. All right, so I'm gonna just cross things out. So we acquire the 60,000, we're done with that. We purchased and used raw materials of $16,000. All right, so that's $16,000 cash. So that's our number 2. Purchase and use raw materials. That costs $16,000 cash. All right, so that was number 2. So number 3, we're paying wages of $22,000 for the cash workers. So paid wages. Let's just say paid direct costs, paid direct wages or direct labor wages. Hopefully you guys can read this. And this is direct labor because it's going to the workers who made the replicas. That's number 3. Get rid of that. Next, we've got our overhead costs of $12,000. So number 4. Incurred manufacturing overhead costs of $12,000 cash. All right, there's number 4. All right, so that's all the stuff we've got up there. So now we've got to come down to actually looking at part D. And it says that, we sold that $800. So, or those 800 replicas. So we're going to start by recognizing our revenue, our sales revenue of 56,000 that we already figured out. So 5 recognized $56,000 in sales revenue. Again, that's from taking the 800 times 70. So $800 of our replicas sold for $70 that we figured out in part C. And if 5 is recognizing the sales revenue, then 6 has to be recognizing the cost of goods sold. So we recognize 40,000 in costs of goods sold. So that takes care of selling. So then we've got our last thing of paying the $4,000 in our period cost to our sales commission. So number 7, we'll just put 7 over here. Paid $4,000 sales commission. So those are our 7 events that we then have to put down on the statements model. Now, something to recognize when we're looking through this. When we look at the words recognized and incurred, like we recognized our cost of goods sold because we didn't actually incur those costs at that time, but that's when they're recognized because even though we may not have incurred that at that exact moment. So keep those types of things in mind. So let's go through this. So the $60,000 cash is already given to us, and that's a financing activity. So number 2, we need to purchase and use raw materials that cost $16,000 each. So when we look at this, we know that our cash is going to decrease by $16,000. So our statement of cash flows goes down. And it is an operating activity because we're purchasing raw materials. But now, is that an actual expense? It is not, because we're using those raw materials to make our inventory. So that 16,000 is going to go into our inventory. Same thing for our direct labor wages. We pay them out now. So that means our cash flow goes down by 22,000. But we aren't recognizing that expense yet because we haven't sold those inventory items. So that 22,000 is in that asset exchange transaction. Number 4, we incur the manufacturing overhead costs. So we have to pay that overhead. That again takes our cash flow down for an operating activity. And it's going to go into our inventory because all of those 3 costs are what our inventory cost us. So next, number 5, we're recognizing that those sales. So that's an increase to our cash. For operating, but now we finally got some revenue. So instead of adding it into inventory or taking it out yet, we're going to give our retained earnings the $56,000 in revenue. And again, our income statement would also have $56,000 in revenue. Now, number 6 would be recognizing that cost of goods sold. So that's where we see our inventory decreasing $40,000. Because we no longer have that inventory to sell. Now that those costs of goods sold are finally coming out of our retained earnings. That is our expense. But we're not actually paying that money because we paid $40,000 in those first 2, 3, and 4 transactions. And then number 7, we're paying out our $4,000 in our sales commission. So cash is going to go down $4,000. Our retained earnings also goes down $4,000. It's another expense, which then takes our net income down. And we see another decrease in our cash for an operating activity. And that is demo problem 1. 10.1.